Alright, welcome to this new video. In this video, we're going to talk about the staircase effect. This framework I'm using to find low and high resistant liquidity, and I favor my own trades to be in low resistant liquidity because the moves are very clean. We're going to talk about low resistance liquidity, high resistance liquidity, how you can spot this in the chart, and we'll go over a few examples to better develop your understanding. So without further ado, let's dive in. When you're searching for low resistance liquidity, that's where your clean moves will be, you need to look for failure swings. And failure swings are swing highs and swing lows that don't take out any liquidity. For example, here's your liquidity, and this move doesn't take out this high. So now there's both money here and here. With high resistance liquidity, you had a high and it got taken out. So it was a liquidity sweep before moving downwards. Because there was a liquidity sweep, this is high resistance liquidity. When I'm taking a short, I like to have high resistance liquidity defending my position. Same at the other side of the curve. You have liquidity here under this swing low. This swing low doesn't take out any liquidity, so there's money here as well. Makes this low resistance liquidity when price trades back into this sell side liquidity pool. High resistance liquidity, this low is taken out by that swing low, making this high resistance liquidity. So when I take a long position, I like to see high resistance liquidity defending my position. When I'm attacking the market, I want to target low resistance liquidity because low resistance means low defense and it's going to be an easier and cleaner move. With this new knowledge in mind, I want to introduce the staircase effect. And it's a signature in price you're going to recognize everywhere. And basically looks like this. This is an example of a long position. So it looks like a staircase down, and then you see big displacement upwards. And these are all failure swings. So there's money everywhere, all these highs. And they are failure swings because no high takes out any liquidity. So price loves to give an energetic move towards low resistance liquidity. And you see there's a staircase. And you can recognize a staircase in this move. So if you see it, try to trade towards it because it's low resistance liquidity. Same for short position, staircase upwards. And all these lows take out any liquidity. Staircase upwards, and then you should recognize a aggressive move lower because under all these swing lows is liquidity, there's money. So price loves to trade there very energetically. Now let's go to the charts and take a look at some examples. Before diving to the charts, I want to explain to you how I use this inside my trading. Before every London and New York session, I will go to the charts and I try to find these kind of setups. So I want to see failure swings. So this is a swing high that does take out any liquidity. Here's liquidity. So I know price is likely to draw into this buy side liquidity pool. Then I wait for price to come back into a discount array. That can be an old low or a bullish for value gap. It can also be a bullish order book, but I prefer old lows and bullish for value gaps. I wait for the displacement from that higher time frame array, and then I'm expecting price to trade it back to this for value gap and to take out this liquidity pool with ease. And that's the same vice versa for shorts. I'm trying to find failure swings here on the buy side of the curve. These are both liquidity pools, sell side liquidity pools. That's going to be the draw on liquidity. Then I wait for price to come back into a higher time frame premium array. That can be a bearish for value gap or old high. I wait for displacement down, see if there's a value gap, order block, breaker, and then I try to catch the move down towards these sell side liquidity pools. So inside this piece of price action downwards, I'm trying to find my entries. At the same time, why do I like to short from here? Because we just took out liquidity. We took out this high. So this high is high resistance liquidity. So I like to short when I have a good defense, and high resistance liquidity is a good defense to take a short. All right, let's now start with training your eyes to see low resistance liquidity and the staircase effect. So currently, we were in a downtrend on the Nasdaq on a 50-minute chart. And then we traded to a higher time frame low. It was a daily low. And if you see price trades to a higher time frame discount array, you see some energetic move up, your eyes should immediately go to failure swings. Where are failure swings? All these highs don't take out any liquidity. I see these highs don't take out any liquidity. So these are two buy side liquidity pools I would want to trade into when longing this price action. This is on the 50 minutes. As you can see, we displaced upwards inside the first liquidity pool. create a fair value gap together with an order block. Why is it an order block? Because we trade down into this fair value gap, and then you can take a setup to the low resistant liquidity. And the signature you want to see in price are failure swings, and you should expect big green candles taking out those buy-side liquidity pools because there's almost no defense. Now let's take a look at the short example. We just took out these highs. And now pause the video, and what do you see? I see all these lows are failure swings. This low does take out any liquidity. This low, this low, this low as well. All these lows, they take out a little liquidity, but not much. We've all this liquidity just waiting to be taken out. And that's where you see the low resistance liquidity, the staircase effect, and you see that energetic move downwards. You can anticipate this price, for example, prior to a big red folder. Then you see price before that, just making that staircase, creating all those failure swings, and then around the 8:30, 9:30, or 10 a.m. event, then you see that energetic movement downwards. There's a reason ICT mentions that you shouldn't trade before big news events, and that's basically because price is just engineering liquidity and just waiting to take all of that out. Now let's take a look at this piece of price action on Nasdaq on a 1 minute. We just had CPI, and then as CPI, we are consolidating towards the open. Pause the video, and what do you currently see? I see currently liquidity being created on both sides, right here and right here. You see, this high takes out this high, but this is not a significant liquidity pool. The liquidity is resting up here and below here. First of all, you want to follow the order flow, and that's bullish. And you want to see what price gives you as a signature. And what price does here is it takes out sell-side liquidity, so it sweeps a low. And what you want to see is aggressive sells out of the range, aggressive buys into the range. And if you see that signature, your eyes should look at, okay, is there any low resistant liquidity we can run? You see, all failure swings, all these swing highs don't take out any liquidity. And you see price displays upward. And what's important here is to note how easy price goes towards this area. It just goes. So the importance of failure swings is that you can get a very clean, low resistant move towards your drawn liquidity. And that's this high right here. Also here in this example on the Euro USD on the 5 minute, we took out a higher time frame high, a daily high. And then you see energetic move downwards. Then the question is, where will price wants to go? Is there any low resistant liquidity? We have equal lows right here. And all these lows don't take out any liquidity. So price shouldn't have too much trouble running all these lows. And that's low resistant liquidity. If you want to take a trade from here, and you see the time, so it's outside the kill zone. But you teach the concept, you see displacement downwards, leaving this fair value gap. We have an order book, you have a breaker. And inside this fair value gap, they're creating high resistant liquidity. Why? Here's the liquidity pool. It gets taken out, then displays downwards. And because this high has been swept, this high has become high resistant liquidity. So if you want to take a short, this could be your protected high because this is high resistant liquidity. So for example, you can take your trade at this fair value gap, targets all the failure swings here, and you can place your stop loss above this high or above this swing high for a 1 to 8 or a 1 to 3. Thank you for watching this video. In this video, you learned about low resistance liquidity and high resistance liquidity and how you can use the staircase effect inside your trades to make the moves you are catching way cleaner than you did before. If you like this kind of videos, please like and subscribe, share it to all your trading friends, and I'll see you in the next one.